And well, moving to the macros, the biggest news of the day is that in the US, the 10-year Treasury bond yields have risen to the 16-year high, topping the 15.5% level. Now, in the past week alone, the bond yields have risen by almost 30 basis points, its biggest weekly surge since the April 2022. And this comes as a first since 2007 on the back of a hawkish Federal Reserve and its warning for more interest rate hikes before the calendar year ends. To give us more details, I'm joined by my colleague Lisa, and later we'll also have Peter Cardillo joining us. But first up, I'll go across to my colleague Lisa. Give us a lowdown of the entire situation.
Right, so US Treasury yields that has topped 5%. Now, to be more specific, it has touched a high of around 5.02%. It's the highest level, multi-year high since 2007, a 16-year high. And they have also posted their largest weekly surge since April 2022. Now, what are the factors that's leading to this multi-year high Treasury yields? First, it's the commentary by Jerome Powell, the chairman of the Fed Reserve. So, what he said that the central bank would remain strong and determined in its commitment to bring the inflation down sustainably to 2% level, and even the lower economic growth that was likely needed to achieve this goal. Now, lower economic growth that is likely to achieve this goal, but on the back of roaring US economy and also the strong economic data that is coming in the form of retail sales. With that, it's expected, the investors are expecting that the rates will remain high for an extended period of time. So higher for longer is the mantra that the investors seeing. Fed futures, Fed fund future pricing, that is also reflecting a 98% probability that the central bank will keep its main interest rate unchanged at the current target range of around 5.25 to 5.5% at its next monetary policy meet. The relentless sell-off in the government bond market, that is also driving the investors to accept that the central banks will keep the rates high for longer. And there are several events also lined up this week. For example, the European Central Bank meeting, the release of the US GDP data, as well as Fed Reserve's preferred inflation gauge, that is the PC index, that will be out. So that is actually leading, that is having a rub-off effect on the US market as well as the Indian market. It has fallen to a 7th month low. So we have to see from this the events which will give us some carry forward as to what the Treasury yields will see going forward on the basis of this commentary coming in.
Thank you so much for the entire picture, Lisa. But tell you what, we are joined by Peter Cardillo, who's the Chief Market Economist, Spartan Capital Securities LLC. Peter, welcome to ET Now Rush Hour.
Thank you.
Peter, my first question is that, the US Treasury yield has ticked up 5%. It's hovering around its multi-year highs. The Fed fund futures pricing reflects a 98% probability, that the central bank keeps its main rate unchanged at the current target range of 5.25 to 5.5% at the next monetary policy meeting. What is the likelihood of a rate hike, and for how long are the rates likely to remain elevated? As according to Fed, they're saying the rates are likely to remain elevated higher for longer.
Yeah, I think they stay on hold next week. That is the November meeting. And then I think there's a good chance that they'll stay on hold even in December. So that means that the Fed is probably finished raising interest rates. But the problem that we have is that the yields continue to go up. And that's because of several factors. If you look at some of the comments that the Fed's recent Fed comments, they stay pretty much hawkish. But again, Powell last week indicated that he would that the possibility of a hold at the November meeting is, I don't want to say a guarantee, but it's pretty much within the marketplace. The problem is that we have macro news that continues to be positive and negative. And then I think the real key here to the rising yields is the fact that, the U.S. closed its fiscal year with a huge deficit, $1.7 trillion. And so you might say that the bond vigilance back in the marketplace. They're looking at that, and that's a huge deficit. And so that's the reason why I think we're seeing yields that are continuing to move higher. And so until we get some movement by the Fed, I think the bond vigilance will probably continue to hike yields here in the short term.
Speaking of the bond vigilance, and you touched upon that, and that brings me to the next question. A few months ago, most people expected that the U.S. government deficit would keep going down with the growth slowing. It was 3.9% last year, and it's actually going up, with growth slowing. It's quite alarming for all the bond investors. U.S. federal government ended its fiscal year in September, with a fiscal deficit of almost, as you mentioned, $1.7 trillion. That's a huge amount that we are looking at. Is this an alarm bell for the bond investors?
Well, it's very alarming, but I think there is a technical factor that's involved here, and that is, the student loan payments, which were already factored in, and of course they were not approved by Congress, and so I think that is probably the reason why we have such an ugly deficit number, and of course a lot of that is due to the tax cuts, and then of course there's this new $100 million that Biden has promised Israel, and also part of that is going to the Ukraine, and so that is a problem. That's a problem for the bond market, and that's means that the government is going to have to increase their auctions, and that's another reason that why we're seeing the yields continuing to go higher. Besides some of the hawkish talk, but the market is already discounted a pause for November.
Right. Peter, speaking of the market, then what's going to be the impact of higher Treasury yield and elevated oil prices on the markets? We can already see a sell-off coming in there.
Could you repeat that? Did you say oil prices?
Yes, my question was, what is going to be the impact of higher Treasury yield and elevated oil prices on the market? I mean, given the geopolitical tension and the tightening of the supply of oil, do we see a major sell-off coming in there? We are already seeing the sell-off in the markets.
I don't see a major sell-off coming right now. I think oil prices are just going to hover around these levels, and they're down today. I think the reason for that is because the market is paying close attention to the Venezuelan vote. As you know, the Biden administration has basically lifted some of those sanctions. So if all goes according to plan, there's another 1.1 million barrels of oil that is going to hit the market. And so I think that sort of counteracts the fears of supply ties and, of course, the unknown of the war factor right now. Obviously, the war factor between Israel and Hamas is expanding, but it is not dragging so far. It hasn't. It doesn't seem that Iran might be involved. And if that's the case, then I think if this Venezuelan oil does hit the market, that's going to serve as a cushion.
Right. On that note, we'll have to let you go, Peter. Thank you so much for joining us today.
Thank you.